Well, thank you, Dr. Rude. There's a lot going on in agriculture, as we all know, that we could spend quite a bit of time. So with just our limited amount of time, Dr. Ward and I decided to try and take some information that we can gather, and how does that translate to the producer level, and what tools can we provide extension faculty with, producers with, that they may be able to start analyzing some of these dramatic impacts that are events that are happening within agriculture right now. So I'm going to start off with just sharing some simple statistics, some places that I look for information, some of the things that I watch. When we look at inflation, right? Anytime we turn on the news, anytime we look at anything on the web right now, I mean, inflation is a big thing. President Biden was at a farm yesterday in Illinois talking about inflation. This is a big deal for agriculture right now. CPI, which is a basket, consumer price index, basket of goods that a consumer would buy, right? We use that as a relative term of inflation. And so you can see, right, the past 2016 to 2020 is that dark red line. 2022 is that blue line, that darker blue line at top. So we're in a level of inflation we haven't seen for many of our, for many years, 30, 40 years for a lot of us. And so this is really impacting a lot of decisions that are being made right now. So this data comes from Livestock Marketing Information Center, LMIC. So for extension faculty, LMIC is a great repository for all kinds of data. This is one that I use all the time. Dr. Fates uses all the time to gather data for a lot. So this is a great resource that we use. But you can see here that inflation is dramatically impacting at the consumer level, and as we'll show also at the producer level. Let's look at this both from a global perspective and from a domestic US based perspective. You can see here natural gas, ammonia, right? These are being used for producing fertilizer, fuels, whatnot, right? So you can see East Asia, Western Europe, we are complaining a lot about the cost of natural gas, but you can see those impacts that are being felt across the globe, right? East Asia, Western Europe, really seeing that. On the ammonia side, right, we've seen just a bigger run up on the ammonia side as we have as other places in the world. So this is what a lot of the key drivers of fertilizer prices. In the spring, we talked a lot about this in our crop schools of fertilizer prices and with what was going on and still going on in Ukraine and Russia. So dramatically impacting the bottom line for a lot of our crop producers. This graph I found extremely interesting. This comes from Farm Doc Daily out of University of Illinois, another great resource. I would bookmark their website, Farm Doc Daily, always providing interesting graphs and information. So this is a fertilizer, the amount imported and produced domestically. So you can see nitrogen, 12% of our US nitrogen is imported. You can see where the majority of that comes from. Phosphate, 9%. Potash, we're heavily reliant on foreign producers for potash, as you can see, right? The Belarus, Russia, then Canada. So you can see that. They compared that to Brazil. Interestingly enough, right? We compete with Brazil on a lot of sides when it comes to agriculture. They're more heavily dependent on some of these other, right? 95% imported for nitrogen, where we're 12%. Phosphate, 75%. Potash, much like us, they're 91%. So dramatic. This is what's driving that potash price and nitrogen, because of those other foreign factors driving that, but not quite as bad as Brazil. But still, those fertilizer prices and energy prices are really changing our bottom line. So this comes out of this is USDA NASS data. So you can see here, this is paid indexes, so almost like a producer price index for chemical, fertilizer, and fuels at the farm level. So you can see, right? So chemicals remain pretty steady and have risen as of late. Fertilizer, 2013, we had high fertilizer prices in the 2008, 2009, 2007, and then it's dropped. We had a period of relatively low fertilizer prices and have seen that. And you can see how that tracks those fuel prices. Energy, those two are tied together. And so you can see those fuel prices and fertilizer prices as of late. When we look at this, historically speaking, this graph here, there's a time when we didn't know if we'd see those prices, those global, for April 2012, October 2008 were the two previous highs. And you can see April 2022, we're well above those two previous highs. So this is a period of input prices we haven't seen or experienced and really impacting bottom line. But I'll show you what's offsetting some of that. So when we think about Utah, just wanted to quickly show you just a snapshot of this. Is the blue line would be last year, and the orange is as of this year average prices. So you can see, right, California almost $70 above where we were last year. Idaho $50. So you look across these western states, we're $50 to $70 above where we were a year ago on sale price. And I've had, just some anecdotal conversations, with prices above 300, but take into consideration, this is average across different quality levels. So when I say 270, that's averaged across these different quality levels. But these hay prices are, when we think about the revenue, and Ruby's going to show the revenue and the cost side. So keep that in mind as we're talking about, capturing some of the sensitivity of bottom line to some of these factors. For our livestock producers, we're watching the price of corn and, thinking about the cost of feed as it's tied to alfalfa as well. Corn is into an area that we didn't know if we would ever see again. So this is just the cash price for corn. When we look at this on a futures basis, so this is the future, this is July 2022 futures. When we look at the previous July contracts, the previous high was right in, that 2012 when that drought came through, and we're above that. So we're seeing, once again, we're seeing prices on some of these commodities that we have not seen before. Winter wheat, same story in winter wheat, seeing prices we haven't seen before in winter wheat. The previous was in 2007, 2008, we saw high prices. We're above those right now. So a lot of these commodities are driving, are going to maintain some profitability on the crop side, offsetting some of those costs. But soybeans, I just wanted to show that just as, right, we're seeing these high prices. Then we talk about cattle. Unfortunately, when we look at cattle, so this is our futures for feeder and futures for live cattle. When we earlier in the year, they've been, rising in the price had been rising as we saw that trend. And then as of late with economic concerns, a lot of these different factors, margins at the packer level, whatever, we've seen that price steadily decline. On the live cattle, we've seen it on the live as well. So unlike the commodity side, on the livestock side, we have these prices that are dampening the profitability projections as we go forward. Talking energy, so this is our August futures for crude and oil. I just wanted to show that in perspective. So this is where we were at 107 just very recently. When we put that into perspective, the past 20 years, that's right. We saw higher in 2008. We had this period 2000. So oil is high, but it's not an area that we haven't seen before, and like we're seeing with some of these other commodities. But it's still going to drive that cost of fuel up. Natural gas, right? We're seeing this natural gas, but when we put this into historical perspective, this is a 1-year chart. This is a 20-year chart, right? Once again, we saw those high prices, 2006, 2008. And so natural gas is high, but we were at a period of really low prices that kind of skewed some of our perspective. But that's still going to drive up these input costs. And we're going to show you how you can implement some of those as we put this into perspective. So
Ryan, as you're transitioning to Ruby here, so this conflict in Ukraine, and Ukraine I've heard referred to sort of as the breadbasket of Europe, is what do we think what impact do you think that's going to have? Are we seeing that already in the futures? And what impact do you think that's going to have on some of these commodity prices, like particularly wheat?
Yeah, wheat is really the one market that's being impacted by Ukraine. There's still a lot of uncertainty, whether, you see pictures of farmers out trying to plant in Ukraine right now, and there's a lot of uncertainty whether they will plant, how much will get planted. And so I think this wheat market is going to be extremely volatile this year and at least next year, depending on what happens there. But that's really going to impact that. Some of the consequences of that is we're seeing a lot of farmers in the West and Midwest that are planting more wheat this year, which we haven't done in a long time. So that could impact the corn markets. That's going to impact a lot of other markets. And so I think this Ukraine issue is sending ripples across all commodity markets right now.
So we were just that intuitive.
Yes,
Okay.
there we go.
All right. So we wanted to and Ryan and I are going to kind of go back and forth here, but we wanted to really kind of show you how you don't have to just be reliant on kind of our examples, but how you can kind of go about really saying, what does this mean down at the producer level? And so that's what we wanted to go with. So the first thing that we do is we pull up a budget. And if you're working with a producer that has their information from last year, they can use their own information. But this is an alfalfa budget that Ryan put together, and it's based upon 100 acres. And so budgets have the receipts here up at the top. And this one's based upon about 5 tons of alfalfa per acre. And the price varied between 200 and 255, and it's around an average around $225 a ton. And then we've got the cost down here, the variable cost, our fertilizer, herbicide, insecticide, the labor, fuel, repairs, other things. And then we have the fixed costs down here. And so in this case, Ryan's budget was showing that we're making $41,000 after our costs on this enterprise budget. And this is an enterprise budget because it's for one enterprise, and in this case, it's for alfalfa. So in order to really kind of look at changes in things, what I like to do is really kind of bring it back down to just a few costs rather than all of the various details that is in this budget. So I want to take the budget and kind of simplify it a little bit. And my goal is I have these templates that I put together, just a generic one on sensitivity analysis. And sensitivity analysis is just saying what happens to percentage changes to our bottom line. And so you can, the green column, you have your own information or the beginning base net situation. In this case, we've got 36% margin. So for every dollar you sell, 36% of it is left over after you cover your out-of-pocket expenses. Then you've got your overhead, your taxes, and this one was for a little raspberry jam out of making it out of your home. And then the blue, you can put in percentage changes. So I've got to find basically these numbers in green from that enterprise budget. And then if I put those in, then I can start to do the analysis. So that's just kind of setting the stage for this. So over here, energy is a big cost, as Ryan said, that's been affected different things. And so I just go through and I kind of look at what things do I think are moving with those energy markets. Fertilizer obviously is dependent upon what's going on now. And so I just take a color coding, and because I think for me, color coding something really kind of lets me just kind of see what's going on and know that I've looked at everything. So over here, I'm just making energy green, and then I can sum up. And then down here, we'd also make fuel would be that same way. And so I can make it green. And I'm going to do that with the other things. And I've actually already done that, but I didn't want to start with my cluttered Excel file. So here's how I start to kind of take that budget and start to pick it apart. But basically, I want to assign all of these costs up to one of these and then add them up. And so if I go, so this version, make it a little bit bigger so we can see it. There we go. So I've got this the budget, and you can see that I've now going down through these costs. All of them are assigned to one of these, and then I've added them up. And so water cost, I put into other, the irrigation labor, operator labor, and also repairs and maintenance. Ryan and I talked about this a little bit, and we felt like repairs and maintenance is coming from the parts, but also the labor based upon that. So the cost of getting repairs done, we felt like it was moving in some ways with the labor market. So we decided for this scenario and for this instance to really kind of look at how to kind of pull these things together to put the repairs and maintenance in with the labor. And then the purplish color, pink color is all the other expenses. And then the fixed cost, we lumped those together into our fixed cost. And so when I did that, we ended up with energy is made up 23% of our revenue. Labor was 16%. Other expenses that we lumped all together were 3%. And then our fixed costs were 21%, leaving our profit down here at 37%. So this is what Ryan had put together as a budget kind of before some of these really big changes that have been happening going on in 2022. So now that we have those, I can, and just to make it easy to see in this presentation and not kind of be going back and forth, what I did was just pull that sensitivity file over here into this spreadsheet. And so you can see that here, I modified these numbers in green to match what I was pulling in here. So my revenue, 111,000. And if I go back over here to my budget, let's just pull that back on the screen. Oh, I don't know, it won't let me do it. Okay. So my revenue is 111,000. That's what I put in here. My energy, it all added up to 23,329. And then my labor, I put that in. This one's left blank. So if I wanted to split it out into one more area, I could. And then I've got my overhead or my fixed cost. And so everything's kind of put in here. So this is the way things are looking now. There's my net income before taxes. If I assume like a 35% tax rate, then that's going to be around $27,000 after taxes. But what we really want to know is not just what we were projecting, but play the what if games. And so here, so over here in this blue column, I can just change whatever we want. And so without anything, it's just going to look like it looked before. But as we start to go in and add in different things, and so Ryan, you can start to chime in here if you would like. But so based upon those graphs that Ryan was showing earlier, energies obviously and our fertilizer costs have gone up. So what percentage do you think we ought to put in there for a change in fertilizer?
At least 30 to 40%. I think that's very conservative.
Okay, so we'll just start with the 30% and then we can change it. So we see that just that change of 30% there brings our fertilizer costs for the 100 acres up to around 33,000. And that alone is going to lower this net income by 19%. We're still making money, but now it's less than it was before. And then labor, everybody's seen all the help wanted signs, heard about the higher labor costs. Would you say like 25% or more?
Yeah.
So we put in the 25%. And then this will show us now we're bringing that margin. This is after our out-of-pocket costs. It was 58 cents on every dollar. With those two changes, it goes down to 47 cents on the dollar. And our net income went from 27,000 down after tax, take 18,000, or before tax, it went from 41,000 down to 29,000. So this is something that you can quickly kind of make those changes. Other expenses, probably like with just inflation, 7 to 10%. If we're going a little conservative here, so just do 7%. And then fixed cost, we can go a little bit higher, maybe 10%. And so you can see that all of those changes bring us down. Our net income goes down by a third, but we're still positive. It was 41,000 before tax. Now it's down to 26,000 before tax. You'll notice that these changes didn't affect it as much, partly because they're smaller percentages, but also mainly this other one is such a smaller number to begin with compared to the others that it's not going to drive things as much as these two biggies. But labor and energy are a huge part of the expenses in alfalfa, and both of those have experienced really strong pressures. So that would bring our net income down by 36%. But there's something else going on in our state this year. And what is that, Ryan?
Yeah, we're assuming we're going to get 5 tons to the acre. We hope that we will be able to, but that's so what if, I mean, it's just, we're going to assume that we're not going to get our full yield this year on alfalfa.
So we were getting 5 tons per acre. So if we went down to like 60% of that, 30 tons per acre, that'd be like we'd lose like 40% of our yield. So that's really going to bring us negative. We're still going to cover our out-of-pocket expenses because the 12% is positive here. But we went from getting around 58 cents on the dollar after out of pocket to 12 cents. And so that no longer is enough to cover those fixed costs, those 26,000 in fixed costs. So now we're going to be negative in income here. That's because our yield went down, but I've also heard that prices of hay have been going up. And so if we assume that the yield might be lower, but maybe the price of hay is going to be a little bit higher, maybe that nets out to only going down by 25%. And if so, then we come down to where we're not too far from breaking even here. We're negative by 1,500, but our margins 29 cents on the dollar. So this is how you can kind of just look at, and why you might want to look at this with a producer is, if I know early in the season that I'm going to be having financial difficulty, Ryan, when would you say is the best time to go start talking to a banker?
The sooner the better. As soon as you even get a hint that things are not going as planned, that's when the communication should start.
So this can help you, instead of kind of knowing that you have some of these things, that prices are going up, but our yield might be down. And then it can just kind of let you start to put that together, what that might look like, and play out some different scenarios. So here, assuming that we do get enough water that you can get your yield, and prices do go up a little bit, maybe instead of being negative, an optimistic one would be that that's positive. And so you can start to look at the breadth of that. But we've also seen energy prices go up by 40% instead of 30%. We've seen some of these other expenses, maybe they go up by 15%. Whoops, wrong column. And so it just starts to allow you to do it. I'm going to go back to my base. So I'm going to assume 30, 15. So this is kind of what we started out with, minus 25%, 30%. 25, 10. So when I look over here, the other thing that I put here together is to link these into some pie graphs. And so these pie graphs and this chart here is based upon what I do with these numbers up in my sensitivity analysis. It just summarizes them. Here was what I had before this is a percent of revenue. Here's the percentage changes I did. And then this is what I have afterwards. And so up here, it's just showing the expenses and I don't have the profit in it. But of your expenses, so the dollars being paid to expenses, 23% of that was going for energy. And with the change that we did now, 39% of those expenses become energy. As a percent of net income, it went from 23% up to 39%. And then you can see that profit here, basically this 37% of profit had to go somewhere, and it went into these higher fixed costs, and it went into higher energy costs and higher labor. But you can see that it just kind of shrunk that profit down to very little. And pie charts don't do well with negative profit numbers or negative numbers. So this is actually a negative and it was a positive, but it just kind of is to illustrate. The other thing that we wanted to go over is livestock. Are there any questions on hay before we leave or anything, any comments? Then I'll bring up the livestock one. Okay. So I did the same thing for the livestock, or Ryan and I did, we talked about it. And we separated out the state range and federal range. We don't really, those numbers won't change, but they're so a minor amount that we just lumped them in with the other. And then, we put again the alfalfa, straw, private meadows. We saw that energy, those labor costs was really driving the alfalfa. So we put that in under the feed together. And then the other expenses, transportation, we put under energy. And then the non-fee grazing cost, that's like the fencing and different things. So that's really more like labor. So we added that up over here. The same thing, put it into the sensitivity table. And I put together those pie charts again. So if it keeps wanting to run away from me. So up here we show that livestock weren't doing as well as the hay. So we're showing that the profits weren't as much to begin with based on the base budget. Margin was 17 cents on the dollar. Net income before taxes around 6,600. And so if we did assume like a 15% drop, and then the same thing, feed, we did the 30% with the energy, labor 25%, energy also 30%. 10% for other, 10% for overhead. It turned that, so this one with livestock, with these changes, even if we assume that the revenue is not going to change, it basically eliminated, and you're not covering your out-of-pocket expenses. And then you're losing, you went from a positive 6,600 net income before taxes to a negative 10,000. And then if we assume that, what's happening with cattle prices, Ryan?
They've been slowly going down. So
over here, and the reason I put this all on one page is so over here, we were assuming 550-pound steer calves, 500-pound heifer calves. And the price of cattle was 1.175 for steers, and then the 165 here. And so if we go down by 15%. That's what it's looking like for us. And then again, I don't know if I think it's based partly on our range conditions and water and stuff, but whether our calves are going to be lighter or not, whether you'll have more death loss or not, those are additional things that you could kind of take into account when you think about changes in revenue. But when I put this in, you can see that this net income or profit was a positive 8%, and that goes down to a negative 19%. So that net income, but it starts to change. And so when you have a negative, again, in a pie chart, it doesn't do well. That's why I did these just percent of the expenses. But you can see that before feed was 47% of your expenses, but with this change, it becomes 67%. And so it just starts to eat up all of that profit. But any comments here, Ryan? Or
There was a comment in the chat box, what factors are pushing cattle prices down? I think the main thing is I showed that graph earlier, the consumer price index. I think the cost of other goods are so high, inflation, that consumers are really, when consumers have money in their pocket, they buy beef. And right now with the economy and with inflation, consumers are really tightening up. And I think that's pushing a lot of those prices down on that beef side. But I think, no, Ruby, I think this captures that the implications of those rising feed costs on cattle is just pushing that, eating up that profitability, just like you said.
So I think some other things to think about for me is that if you see, we didn't do it for dairy, but if you see this this cost of feed really cutting into the profit on the cattle beef side, you also know that the cost of feed is going to be really affecting the dairy also, where a lot of our hay goes. And so one thing that I would also think about as I was back here looking at the hay is I think another pressure that we have here is not just from the lower yield, maybe because of the water and stuff, but are they going to get paid for their feed? So I think that sometimes hay is something that as things start to tighten up in other areas, it's hard to get paid for it. We sell hay on it, as Ryan said, we sell a lot of hay on a handshake. And so it's also just kind of, are people going to, be selling hay that, I don't know if I'm going too far with that, but I think hay is definitely one of those things to really think about. Will they get all the money collected if there's financial pressure on their, and that's a small amount, but I think sometimes getting not paid for like one load for one farmer can still be a significant thing for that producer.
Ruby, there's another question asking about are Texas producers culling yet due to the drought? I haven't seen any data indicating that yet, that those are anybody's starting to cull down south. That's something we are definitely watching. I think that's something that, we've had these rains lately. They haven't by no means fixed anything. But that's one of the big questions and key things that we're going to be watching is to see what happens with culling both in Utah and in our neighbors. And especially as we watch, that's what we were watching last year is that drought kind of subsided in Texas, but we're watching it right now. And if that drought creeps into Texas and if they start culling, then there'll be some big market impacts. We just haven't seen those quite yet. That drought, it's precarious, but it's not to the, I don't think anybody's culling quite yet in Texas, but we are definitely watching that.
So
I had a real quick question.
Yeah.
This is Matt. So I might have missed this, being there long gone a little late, but is there any prediction of what % of our hay product will actually produce this year due to drought? How much are we going to be down?
In Utah?
Yeah, in Utah.
it's still, the one advantage is we went into the fall with a little more soil moisture than we did in 2020, the fall of 2020 into 2021. So we came into 2022 with better soil moisture. Right. You talk to guys in central Utah and Sanpete County, they feel like they're in a little better situation. The problem is we just didn't get enough snowfall that's one of the, how are those reservoirs going to be filled up and how long? So I think we're going to see at least I think a conservative 25% drop. I think that's very conservative. I think it's probably going to be more than that, but I think at least a 25%.
So this was meant to just give you a feel for how you could start to bring sources for some of the information that we're seeing as we go through, and then how you can kind of bring it down to the producer level and also modify for individual situations. And so we used some of the enterprise budgets that we had here for the state of Utah, but this could really be done with anybody's information if they just get it back down to those few things, types of expenses. So I will share those Excel files that we used with Carrie, and so he can share them. They're really cluttered, but I liked having everything kind of on one screen so you can see everything. So
is there a Ruby, and is there a central place that these files are? Maybe we can just send a URL out.
okay.
If that's okay, instead of big file, or instead of files. They're not all that big, but
should we, so we can put them on the APEC website, I think.
Yeah, we can just upload them there.
And then the other thing, let's see. Another good presentation that's not on the APEC website, but it was at the Urban and Small Farms Conference. And so I'm just going to share my screen again, just before we go. And there we go. So the Urban and Small Farms Conference is here at the diverseag.org website that many of you on here participated in that and helped with it. But if you go down to Thursday afternoon in the marketing management segment, Kinda Curtis went over what's up with inflation and prices, and we've got her PowerPoint and recording here. And then I have the generic financial health evaluation tool and my presentation here too. And that version of the file that's there I did it with raspberry jam, flowers, and vegetables. And so rather than, I didn't have the whole budgets here and stuff, but I went through and did the sensitivity analysis and preloaded the green numbers with those. And so if you're interested more in small farms and stuff, you can use these ones too, or that's also a source for information. And that's it, again, the Urban and Small Farms Conference recordings on diverseag.org. And we'll put the rest of them on our APEC extension website.